Thanks for checking out this video. Before we start, I am not a financial advisor and none of this should be considered financial advice. This tool is for educational and personal planning purposes only. It does not constitute financial, tax, legal or investment advice. All projections are estimates based on the values that you enter and are not guaranteed. Hi and welcome back. In this video I'm excited to announce a new addition to version 5 of our retirement income planner, and that is this Drawdown Strategies area here. If you've been using the retirement income planner, you've been building your plan from an income side, setting a monthly target and testing whether your portfolio can sustain it across every phase of retirement. Today I'm going to show you this brand new tab that approaches the same question from the opposite direction. Instead of asking, can I afford this? It asks, what do the world's most tested withdrawal strategies say I should be spending? 6 strategies, all running on your actual numbers, all generating personalized recommendations, and they all live in one place. Let me show you how to use it. At the top of the screen, you'll see this new Drawdown Strategies tab. It sits right before the tax and ACA notes. Click it, and the first thing you see is a summary of the inputs driving this analysis. Your total investable portfolio broken down by account type, your guaranteed income floor, social security, pensions, anything that doesn't depend on markets, and your key assumptions: retirement age, life expectancy, growth rates, inflation, and at the very end, the number everything gets compared against, your plan's average net monthly income. This summary box matters because every strategy uses these exact numbers. There's no separate data entry. Everything flows straight from the existing plan that you've already been working on. The drawdown strategies that we're going to look at are going to be the 4% rule, variable percent, 3 buckets, floor and upside, Guardrails, and Monte Carlo. And we have adjusted our portfolio value here slightly, and we've extended it to age 90 for this example. This assumes that we've already worked on our monthly income strategy in the normal way that we normally would, and now we're kind of testing it against these other strategies to see how it performs against other very popular retirement income strategies. Let's start with the 4% rule, probably the most cited number in all of retirement planning. This comes from the Trinity study and William Bengen's research in the 1990s. If you withdraw 4% of your portfolio in year 1 and then inflation adjusts that dollar amount every year regardless of market performance, historical data shows your portfolio survives 30-year retirements around 95% of the time. Each strategy answers, given my portfolio, what can I safely spend? This is a complementary lens to your plan's income target approach. Your plan average net of $4,245 a month is the benchmark shown in every result. So what that means is, if we go to the overview here, we already worked out that our average monthly income is $4,245 throughout the duration of this retirement. So 4,245, this number here, now becomes the benchmark that we're going to measure these other strategies against. So if we break this down for this 4% rule, it's telling us that our portfolio withdrawal is $1,633 a month, and we have a guaranteed floor of $1,850 a month. Now the guaranteed floor is from the Social Security. That's guaranteed no matter what happens to the market, so that's called our floor. And then our total monthly income in this scenario is $3,483, and it says versus your plan average minus 762. What does that actually mean? Well, let's have a look down here in the Insights and Recommendations tab. It says your plan withdraws $762 a month, more than the 4.2 rule suggests is sustainable long term. And it's giving us some ideas here. It says consider reducing phase 1 or 2 portfolio withdrawals, or delaying Social Security to rise the guaranteed floor. So let's actually jump in and make one of those changes just to see how it affects our plan. So we're going to edit all values, and for now, actually before we do this, we're going to adjust to age 65. We're going to say, well, what would it be if we retired at 65? So we'll go to a Social Security optimizer. It says 2,290 a month. So when we adjust now to age 65, we're going to put 2,290 a month in there, and then we'll look at our drawdown strategy again. Now remember, before it was like 760, we were overspending, and now we're only overspending by $108 a month, which is actually much healthier. So now what does it say? It says your monthly income target aligns closely with the 4% rule. Your plan is in the safe zone by this benchmark. So our insights and recommendations are updated based on the tweaks and the changes that we make. And carrying on with this analysis, it says your guaranteed income covers 58% of total 4% income. The portfolio only needs to fund the remaining 42%. A stronger floor, example, delaying Social Security, directly reduces portfolio risk, which is what we did. With a $490,000 total portfolio, each 0.5% rate changes shifts monthly income by $204. Small adjustments matter significantly at this portfolio size. So let's see what happens if we do adjust this. If we move this, say, to a 4.5% rule, or some people are comfortable with a 5% rule. So we've all heard of the 4% rule, but what would happen if we wanted instead to stick to a 5% rule? Well, in this scenario, we can see that actually we're under withdrawing our portfolio value by $300. And now let's look at our insights. It says the 5% rule suggests you could spend $300 more than your current plan. You may be planning conservatively. Consider whether increasing discretionary spending in early phases or accelerating Roth conversions makes sense. And again, we've got the further analysis there, but I'm thinking that we probably would be good to go back to retiring at 62. With 1,850 here. And we'll go to here. Now we can see we're still not quite at the benchmark there, but if we go to, say, the 6% rule, we can see that we actually have an extra $55 a month leeway there. So yes, there's a 4% rule, yes, there's a 5% rule. A lot of people feel comfortable with the 6% rule. So if you're happy with the 6% rule, this is kind of confirming to us that that strategy would work for you. Your monthly income target aligns closely with the 6% rule. Your plan is in the safe zone by this benchmark. This chart shows two lines. We have the blue line, and this is your portfolio under this withdrawal strategy. blue line here. The grey dashed line is your actual plan's portfolio trajectory. If the blue line runs above the grey line, this strategy preserves more capital. If it drops below and runs out before the grey, that rate is too aggressive for your portfolio size. So my recommendation here, and again this is not financial advice, not a financial advisor to remind you, but my recommendation for using the tool would be to run the slider until you find the rate where your versus your plan card reads close to zero. That's the rate the research says matches your income target. If the rate is above 4%, your plan is in the safe zone. If you need 5.5% to match your target, that's a conversation worth having with yourself. The 4% rule has one known limitation. It's rigid. It doesn't respond to what markets actually do. Variable percentage withdrawal, VPW, fixes that. Instead of withdrawing a fixed dollar amount every year, variable percentage withdrawal withdraws a percentage of your remaining portfolio that's calibrated to your growth rate and how many years you have left. As you get older and your horizon shortens, the percentage rises. The math is designed so that your portfolio reaches exactly zero at your life expectancy. No money wasted sitting untouched and no risk of outliving it. Look at the three income cards. What you'd receive at the start of retirement. Here, in this case, $4,770. At the midpoint, $5,467. And near the end, $6,422. Notice they're rising. That's intentional and actually reflects reality. Many retirees spend more in their 70s on healthcare and less on travel than the reverse. So let's look at the first chart here, total monthly income trajectory. The income trajectory chart shows this rising pattern clearly. The blue line is your VPW income. The grey dashed line is your plan average, and your plan average is up here as well, $4,245 a month in this scenario. Where they cross, if they do, tells you at what point in retirement variable percentage withdrawal would exceed your current target. And the next chart here, the portfolio balance trajectory. The portfolio balance chart shows the smooth drawdown to zero. Contrast this with the 4% rule chart. Under 4%, capital often remains at death. Under VPW, it's deliberately consumed, which means you use up all your money, you just don't want to leave any unspent. The insights section will tell you whether VPW is a good fit for your spending pattern. If you need stable income, the same amount every month, VPW may feel uncomfortable. If you are flexible about spending more in some years and less in others, it's arguably more mathematically honest than any fixed rate approach. Let's have a look quickly at what our recommendations are for this particular scenario. It says VPW income rises 30% from $4,770 a month at retirement to $4,622 a month, $6,422 a month near age 90, because a higher percentage is withdrawn as your maximum horizon shortens. VPW generates more than your current plan throughout. You have room to increase discretionary spending or redirect surplus to Roth conversions in early phases. Unlike the 4% rule, VPW is self-correcting. A strong market year rises the next year's income. A poor year reduces it. This requires spending flexibility, but eliminates the risk of depleting the portfolio too early or leaving excess unspent. And in this case, your guaranteed floor, $1,850, cushions the variable nature of VPW in years when VPW withdrawals are low. Your essential income remains protected. And next we will look at the 3-bucket drawdown strategy. As we'll see with the bucket strategy, this does work best in this particular scenario when we have some money in a Roth account. So let's just go to the edit all values here, and I will show you that in the Roth IRA section here, I've just added a balance here, 55,000. I've just added that in to help us understand this 3-bucket strategy a little better. So let's take a look at that now. The 3-bucket strategy is less about mathematics and more about psychology, and that's exactly why it's so effective. When markets crash 30% in your first year of retirement, this strategy stops you from panic selling growth assets at the worst possible moment. The idea is simple. Divide your portfolio into 3 time-segmented buckets. Bucket 1 holds 3 years of expenses in cash. You draw from this one only. Bucket 2 holds 7 years worth in balanced investments. It refills bucket 1 annually. Bucket 3 holds everything else in growth assets. It doesn't get touched for decades. So here's bucket 1, and we'll take a look at our recommendations in a minute, but currently we have 60,000 in here, and it's telling us that our target is 86,221. Bucket 2, we've got the 55,000 in here. It's telling us our target is 201,000 for this scenario. And bucket 3, it has 430 and the target is 517,329, so that's 83% funded currently. What the tool does automatically is map your existing balances to these buckets. Your cash savings becomes bucket 1, your Roth IRA maps bucket 2, and your 401k and equity balances go to bucket 3. Each bucket has a progress bar showing you how fully funded it is against the target based on your monthly portfolio need. Green check marks means that it's fully funded, and amber means there's a gap. The bottom row shows the total, how much your buckets need versus how much they have. Here's how to use this. If bucket 1 is underfunded, that's the most urgent thing to address before retiring. That cash buffer is your psychological and practical protection against sequence of returns risk. If bucket 2 is underfunded but bucket 3 is strong, your long-term position is fine, but you may want to shift some conservative 401k allocation into a more liquid position. The recommendation that matters most here: what is the monthly amount at the bottom left card labeled monthly portfolio need here? That's what your 3 buckets are sized to support. If that number aligns with your monthly plan, your bucket targets are calibrated correctly. Now that's a lot to take in, and it may be useful to kind of study some of these strategies in a little bit more detail, but in order to help as much as possible, our retirement planner here does have this insights and recommendations. So it's not so important to have a deep understanding of this, because we can kind of just, if we want to use this, we can go with the recommendations that our planner has given us. So it says that our bucket 1 shortfall is 26,221. It says aim to hold at least 86,221 in cash or stable deposits before retiring, enough to cover 3 years of portfolio withdrawals without touching equities. Bucket 2 is under 50% funded. If your Roth balance is modest, consider designing a portion of your 401k in conservative allocations, bonds, balanced funds as the medium-term buffer. The bucket label matters less than the allocation. And the bucket strategy's primary benefit is behavioral. When markets fall 30%, you draw from bucket 1, which is the cash, and let bucket 2 and bucket 3 recover, avoiding the panic selling that permanently impairs retirement plans. Next, let's look at the floor and upside strategy. This is the strategy that most directly reflects how this planner is already built, and it might be the most reassuring of all of the 6 strategies. The floor and upside approach divides your income into 2 categories. The floor is the income that never depends on markets, social security, pensions, any kind of guaranteed income stream. The upside is income your portfolio must find, the gap between your target and your floor. So if we look at these cards here, the first card is your guaranteed floor, and it's guaranteed because this is your social income, and that is reliable, or should be reliable, hopefully, and will raise with inflation. The second is your portfolio gap, what the portfolio must deliver per month after guaranteed income. The third card tells you how large a portfolio would need to fund the gap at a sustainable 4% rate. And the fourth card is the one that matters: surplus or shortfall versus that required portfolio size. If you have a surplus, and many users do once Social Security is factored in, that's a powerful number. It means your portfolio doesn't actually have to do as much work as it might seem. The coverage ratio bar tells you what percentage of your average monthly target is guaranteed. If that number is above 60%, you have excellent downside protection. Even if your portfolio does poorly for several years, the majority of your income is untouchable. And we can see that we're a little bit below the ideal number here, and so that is something that we could rebalance our portfolio to help with. Now this table is where it gets really useful. It shows every phase of your retirement. The coverage ratio changes as Social Security and pensions activate. In the early phases before Social Security starts, coverage might be low. Once Social Security is running, the coverage will jump. This is your retirement income plan displayed as a risk profile across time. Read the insights section here carefully. It says you're short by a specific amount to fund the gap at 4%. There are 2 levers to consider. One is delaying Social Security by 1 or 2 years to increase the floor, or reduce your portfolio withdrawals in early phases to shrink the gap. So let's just have a look. Again, that's a lot. Let's just have a look at our actual recommendations that our planner has given us. It says that our moderate floor coverage at 44%. So we have a moderate floor coverage. Your plan has meaningful guaranteed income, but the majority still comes from the portfolio. Delaying Social Security would directly increase this. So okay, that tells us that in the actual recommendations here, so that's something that you can consider without necessarily having to have a deep dive in how all these strategies work. Just follow the insights and recommendations. The portfolio is $173,512 short of what's needed to fund the gap at a sustainable 4% rate. Consider increasing guaranteed income, delaying security, or reducing the monthly income target. And the phase-by-phase table shows us how your coverage ratio evolves as Social Security and pensions activate. The rising floor coverage across phases is the core strength of your income plan. So next we'll look at the guardrails area here. Guyton Klinger guardrails were developed to solve a real problem. The 4% rule often leaves large amounts of unspent money at the end of the retirement plan duration because it's too conservative. But raising the rate increases risk. Guardrails thread this needle. You start at 5%, higher than the 4% rule, but with 2 automatic safety valves. If markets fall enough that your withdrawal rate creeps above 6% of remaining portfolio, you cut spending 10%. If markets grow so strongly that your rate drops below 4%, you give yourself a 10% raise. So what does this mean in practice? Let's have a look at these metrics here. So these 3 income figures actually tell the story, starting with our 5% income here. And then we have the cut scenario, what you'd receive after the maximum guardrail reduction. And then we have the raise scenario, and this is what you'd receive after markets reward you. And then you have your plan average for comparison. And we have an explanation box here that you can read at your leisure. This box shows the actual portfolio values would trigger each guardrail. This is important. You can look at these numbers and ask, how likely is my portfolio falls that far? If your starting portfolio is 600,000 and the cut triggers at 417,000, that's a 30% drop. Significant, but not unusual in a bad market year. So let's look at the graph here, and this shows 3 simulated trajectories. The bull market is in green, the base case here is in blue, and the bear market is in red. The number of raises and cuts triggered in each scenario is shown by the legend. If the bear scenario only triggers 2 cuts, that's reassuring. If it triggers 6, the strategy may be too aggressive for your portfolio. And we've got 18 raises in our bull scenario and 8 cuts in our bear scenario. So again, a lot to understand there, and something that we can dig into and learn more about. But let's just have a look what our planners' insights and recommendations are telling us. So our guardrail starts at $4,121 a month, slightly below your current plan average. Reducing your planned withdrawals slightly would let you adopt a guardrail approach while maintaining a comparable income level. Even after the maximum guardrail cut, income remains at $3,894 within the 15% of your plan average. Your spending plan appears flexible enough for guardrails to work comfortably. So that's something that should give you some reassurance and confidence about your plan. The bear market simulation triggered 8 spending cuts. A larger cash buffer, bucket 1, or higher guaranteed floor would absorb poor return sequences and reduce guardrail trigger frequency. So again, some advice there on how we might be able to tweak our withdrawal strategy. Guardrails work best when your guaranteed floor covers essential expenses, including housing, healthcare, and food. Then guardrail cuts only affect discretionary spending. Psychologically and practically much easier to absorb. And finally, we will look at the Monte Carlo strategy here. Monte Carlo is the strategy that runs last and ties everything together. Rather than using average market returns, it runs your full retirement plan hundreds of times with random return sequences drawn from a normal distribution, the same way markets actually behave, with some good years and some bad years in unpredictable order. Now, we can actually, if we go, let me just quickly go to our edit all values here, and we do have a Monte Carlo settings area here where you can change the parameters with which the Monte Carlo strategy might run, but this is our default, but just to let you know, that is something that you can do. The fan chart shows the full range of outcomes. The blue median line is the middle of all simulations here. The dark band covers the middle 50% of outcomes. The outer band covers the middle 80%, and the red dashed line is the bottom 10%. Your worst case realistic scenario. If the red line stays above zero, your plan survives even in the worst 10% of market histories. That's the goal. 4 metrics. Median portfolio at your final age. The P10 pessimistic scenario. The P90 optimistic and probability of solvency. And if you're above 80% probability, your plan is in the green. 60 to 85% or 65 to 80% is moderate. Below 65%, consider reducing withdrawals or extending the timeline before retiring. The sigma setting that controls the width of the fan are in the Edit tab under the Monte Carlo settings, and you can tighten or widen the return volatility to match your actual portfolio allocation. So now it's time to put all this together, and here's how to use all 6 together to build genuine confidence in your plan. Start with the 4% rule. Find the rate that matches your income target. If that rate is below 4.5%, your plan is historically safe by this benchmark. Note the rate. Go to floor and upside. Check your coverage ratio. If it's above 50%, your guaranteed income meaningfully reduces your market risk. Note what phase your coverage becomes strong. Next, check the 3 buckets. Is bucket 1 funded? If not, that's the most important thing to address before retiring. A well-funded bucket 1 is what lets you stay calm in a down market. Run the Monte Carlo simulation. Look at the probability number. If it's above 80%, all the other strategies are telling a consistent story. If it's below 70%, revisit your withdrawal amounts. And finally, go to variable and guardrails. These are optional refinements. Therefore, when you want to explore getting more from your portfolio or understand what flexibility is available. When all 6 strategies broadly agree, when the 4% rate is sustainable, the floor coverage is solid, the buckets are funded, the Monte Carlo is above 80%, and when you move from hoping your plan works, that's when you can move to knowing your plan works. That's what this tab is for. Not just more numbers, but convergent evidence from multiple independent frameworks, all pointing to the same conclusion about your retirement plan. The number that keeps coming back to this is this one. The difference between what each strategy suggests and what your plan targets. When that number is close to zero across multiple strategies, your plan is calibrated. When it's consistently in one direction, you have a clear signal about what to adjust. If you found this useful, please reach out to me if you have any questions. The retirement planner is available on our Etsy store. Once again, I'm not a financial planner or analyst. None of this is legal advice or financial advice in any way, but hopefully this will help you to use the tool in a way that gives you confidence in your own retirement scenario. And drop any questions in the comments. I read every one. And I'll see you in the next video.